Despite today's move lower and new tariffs from China, the S&P is still just about 0.5% away from an all-time high. Can anything stop this march to new records? So let's bring in Matthew Dizak. He's fixed income strategist with Merrill Lynch and U.S. Trust. Well, we talked about the S&P 500 in stocks, but you're a fixed income guy. I want you to talk me through the flattening yield curve, what it means for me and my bonds that I own now. What should I be doing?
Gotcha. Okay, so it's an important question. The flattening yield curve is nothing to be concerned about. A lot of investors are worried about it. If you're worried about it, don't. Relax. It's absolutely normal. If you watch what happens as the unemployment rate continues to lower, the Fed raises rates and the curve naturally flattens. So if you look at where we are now, we've been between 0 and 50 bips for a while. If you look back to the late 90s, it stayed between 0 and 50 bips for almost 5 years, the end of the late 90s. So it's not at an unusual place right now.
But wait a minute. I mean, as they raise those short rates, if the economy is strengthening, the long rate should be going up as well. And they're not. And that's why we're getting this flattened yield curve, where some people are fearing that we're going to get an inverted yield curve. Why shouldn't we be worried about that?
Definitely getting a flattening 2s, 10s curve, right? But where we are in the flattening right now, around 30 basis points or so, is not unusual with the unemployment rate at 3.9% and trending lower. If we keep going at the rate we are, in terms of unemployment claims and jobless claims, in terms of the unemployment numbers, we're back to levels we haven't seen since Johnny Cash was on the radio with A Boy Named Sue in 1969. So the economy looks fantastic. It looks really good right now. So a flattening curve shouldn't be a concern. If you look at the Fed funds to 10-year curve, right, with the Fed funds rate midpoint of the range at 1 7/8 right now, and the 10-year around 3%, you're still got more than 100 basis points of curve between the policy rate and the 10-year rate. That is much more important for forecasting a recession. Again, the shape of the curve right now is not to be concerned about.
Let's bring in Tim Courtney, Chief Investment Officer with Essential Wealth Advisors. What do you think? Is the inverted yield curve a reason to sell stocks?
I don't think so. You know, we still are in a positive slope. And a couple things, I think that we need to take into account is the fact that the interest rates, the previous times they've inverted, if you go back and look at over the last 7 recessions, we were at much, much higher levels. And so it's very unclear why, at this level of interest rates, why that would really pretend or why the Fed's actions in raising the shorter end of the yield curve would be enough pressure to kick a really strong economy into recession. So I don't think so. It's a measure that we look at, but with so many other measures flashing strength, it's just one you just want to watch, but not not act solely on that one measure.
Last night on Nightly Business Report, since I plug my own show, get to do that right now, we talked about late cycle investing, and inflation is usually something that crops up late in a business and economic cycle, and maybe you start thinking about some inflation hedges. Would you be thinking about that at this point, Tim?
Yes, certainly. You are seeing that ripple through, and looking at, reading a lot of the earnings reports, you see that's a topic that comes up again and again with them mentioning inflation and rising prices. And so I think, you're never quite sure where the interest rates are moving. So I think you take a diversified approach, and things like TIPS can protect against unexpected inflation moving forward. Other assets like floating rate notes you want to include, and just, diversification has been practiced on the equity side for a long time. It's probably good to do that on the fixed income side as well.